Hey, welcome back. It's JWalter here. In today's housing market update, I want to share a news headline that's gaining a lot of attention right now. And that news headline reads, mortgage applications drop to its lowest level in over 2 years. So I'm going to take a deep dive into this and see what's actually going on so you can be more informed about our current housing market right now. So this is according to the Mortgage Bankers Association. This is from CNBC. This is an article based on this report from the Mortgage Bankers Association. So if you're not aware, the Mortgage Bankers Association, or the MBA, reports mortgage application numbers for all houses as well as for new home sales as well. So stay tuned here in a little bit too, because I'm going to share some troubling data that I found that you should be aware of, as well as mortgage applications for new houses. And then towards the end of this video, I'm going to share some updates regarding mortgage loan forbearance numbers. In any case, according to the MBA, as of February 23rd, for the week ending February 18th, mortgage applications decreased 13.1% from 1 week earlier. However, mortgage applications are not just purchase applications. So the total mortgage applications they look at are refis plus purchases. So have a look at this. They have a refi index, and they stated that that decreased 16% from the previous week and was 56% lower than the same week 1 year ago. The seasonally adjusted purchase index decreased 10% from 1 week ago, but the unadjusted purchase index decreased 6% compared to the previous week and was 6% lower than 1 year ago. So basically this 13.1% drop is really mostly due to the refinances dropping by 16%. And this is really no big surprise because mortgage rates have been increasing greatly, over 1% since August of 2021. In any case, when you read news headlines like this, mortgage applications dropping to its lowest level in over 2 years, you really have to see what really makes up that number. And because refis have been falling off the map really, because rates have been increasing so greatly, that has caused overall mortgage applications to dip 13%. So I hope that makes sense. In any case, Joel Kahn, who's one of the vice presidents of the MBA, stated that the 30-year fixed rate mortgage was 4.06%, almost a full percent higher than 1 year ago. Higher mortgage rates have quickly shut off refinances, with activity down in 6 out of the last 7 weeks. On the purchase side, purchase applications already constrained by elevated prices and tight inventory also has been impacted by these higher rates and declined for the 3rd straight week. We'll have to see if this continues because mortgage rates right now are around 4.15, 4.2%. And back in August, rates were around 2.75%. So for every 1% gain in mortgage interest rates, that causes a 10% decrease in buyers' purchasing power. So if you're pre-approved for $300,000, then now because mortgage rates have increased by 1%, then now you're suddenly pre-approved by $30,000 less than that. They went on to say that the average loan side, and by the way, these are for applications for mortgages, that did not decrease last week or increase, but it remained very close to the survey's record high. So we're seeing near record high levels of home prices, but also for loan sizes as well. And here's something I definitely want to bring to your attention. And this is something I actually found out just about half an hour ago when I was analyzing this data for you guys. And that is, out of the total applications for mortgages, the share of adjustable rate mortgages, or ARMs, that share of activity increased to 5.1% of total mortgage applications. This is a very big risk, in my opinion, to, let's say, buy a house with a 5-year, 1-year ARM, because your fixed rate mortgage is only fixed for a short period of time and then it becomes variable. So because mortgage rates have been increasing greatly and they also are forecasted to continue to increase, this is a big risk. So have a look at this, because I noticed this 5.1%, that number has been increasing. Let's have a look at this, because this is from about a year ago, or just over a year ago. It was posted on January 13th, 2021. So this is again according to the MBA. For the week ending January 8th, 2021, just over 1 year ago, have a look at this. The share of activity for ARMs back then was 1.6%. So now we're at 5.1%. That's a big issue, because one potential reason why people may be using or opting for an adjustable rate mortgage is because the interest rate is lower. So have a look at this. This is today's rates. This is as of the 25th of February. Right now, at the time of this video, the average 30-year fixed rate mortgage is 4.18%. 15-year, 3.44%. FHA loan is 3.75%. But have a look at this. The 5-year, 1-year ARM, which means that your mortgage payment is fixed for 5 years, or your payment is fixed for 5 years. And then after that, your payment becomes adjustable because the interest rate is also adjustable. It adjusts to current market conditions. Any case, look at that, 3.72% compared to 4.18%. So my concern here is that some people may be seeing this lower rate and may be enticing them to use an adjustable rate mortgage because the rate is lower than a 30-year fixed rate mortgage. The big advantage, of course, to a 30-year fixed rate mortgage is that your mortgage payment is fixed for 30 years. So you don't have to worry about fluctuations in rates like we are seeing right now. So comment below if you think that's a risk to our housing market. I think that this is a big risk for people looking to get into an adjustable rate mortgage, given that mortgage rates are increasing greatly. In any case, changing gears slightly, let's talk about new home purchase applications, and then I'm going to give you an update regarding mortgage loan forbearances. And according to the MBA, for January 2022, mortgage applications for new home purchases decreased 12.5% compared to 1 year ago. Compared to 1 month ago, applications increased by 10%. As we all know, about a year ago, our housing market was in full swing. So I'm not too surprised that we have a decrease compared to 1 year ago. However, we're about to see how this changes in the coming months, given that rates have increased greatly. So Joel Kahn said purchase applications for new houses fell on an annual basis in January, but the 10% monthly gain is a positive sign to start the year. We'll have to see if that continues. While homebuyer demand remains strong, purchase activity is being constrained by higher prices and building delays due to supply chain pressures and building material shortages. And the U.S. Census Bureau reported that home prices in January for brand new houses were not too much less than all-time record highs. They went on to say purchase activity for new houses continues to be concentrated in the higher end of the market, and overall sales prices continue to increase, as evidenced by another record-setting month for the average loan size of $427,000 for a brand new home. Here's something I found very interesting as well, because they break down all the mortgage applications for brand new homes by product type. So for conventional loans, that made up 77% of all loan applications. FHA was 13%. USDA was 0.5%, VA loans was 9.5%, and the average loan size of new homes increased from $423,000 in December to $426,000 in January. Okay, so changing gears slightly, I want to give you an update regarding mortgage loan forbearances. So the MBA releases a monthly report. They used to do it on a weekly basis much earlier on during this pandemic, but they're doing it on a monthly basis. So here's what happened in January here. The total number of loans in forbearance decreased by 11 basis points from 1.4% down to 1.3%. What this basically means is that 1.3% of the loans that we have are in forbearance right now. This is much higher. Back in May of 2020, this number was a lot higher. I think it was around 10% if I'm not mistaken. In any case, according to the MBA's estimate, 650,000 homeowners are in forbearance plans. Back in May of 2020, this number was almost 5 million. So we've come down quite a bit. Here's what I want to point out to you guys though. So, what are people doing when they exit forbearance? I've been reporting to you guys this on almost a monthly basis for a long time. And I want to show you what the latest stats are. So of the cumulative forbearance exits, meaning all the people who have ended their forbearance plans, these are homeowners, by the way, who stopped making their mortgage payments because they got permission from their loan servicer to do that. In any case, from all the exits from June 1st, 2020 through January 31st, 2022, here's what they did when they exited forbearance. So 29% did a loan deferral or a partial claim. That's where all their missed mortgage payments are just added to the back end of the loan, and their mortgage payment remains the same, but the term of their loan just is a little bit longer. 19% just continued to make their monthly mortgage payments even though they didn't have to, and 17% did not make all their monthly payments and exited forbearance without a loss mitigation plan in place. So a loss mitigation plan basically means a loan modification, a loan deferral, a reinstatement. There's a lot of options for most homeowners who exited forbearance, but these 17% for whatever reason have not entered into a plan, and that's a big issue. And this number, by the way, has not really been increasing. It's been around 16 to 17% for several months now. In any case, about 15% did a loan modification. That's where your term or your rate or your rates are changed in order to make it for a more affordable housing payment, a more affordable monthly housing payment. So 15% did a loan modification. About 12% did a reinstatement in which all their past due amounts are paid back when they exit forbearance. If you have a federally backed mortgage, you do not have to do this. There's no requirement to do this, but some people opted to pay back all their missed mortgage payments once they exited forbearance. 16.8% either paid off through a refi or selling their houses. This is a very low number. This number really hasn't changed in the months because a lot of people were saying that because people are entering into forbearances, once they exit, they're going to sell their house. And that's going to flood the market. It's going to crash the housing market. That's not what the data is telling us because only 6.8% either refied or sold their houses. So we're not seeing a big influx of inventory from forbearances. The remaining 1.3% either did a repayment plan, a short sale, deeds in lieu of foreclosure. So basically a foreclosure or other reasons. And by the way, the 5 states with a high share of loans that were current were the following: Idaho, Colorado, Washington, Utah, and Oregon. And the 5 states with the lowest share were Louisiana, Mississippi, New York, Indiana, and Illinois. And here's the figure that's really good to see here. The total completed loan workouts for 2020 and onward, meaning all the people who had entered into a repayment plan, a loan deferral, a loan modification, were current, meaning they still abided by their current plan. They still were paying on time. As a percentage of total completed workouts, that actually declined, but we're still at 82% of all the people who are in a loss mitigation plan in place. So around 18% are not current. So that's a big issue, of course. So I'll have to keep an eye and see if this number decreases or if it increases. So I'll keep you posted regarding that. And by the way, this represents 73% of all first mortgage servicing volume. So what's your biggest takeaway from today's video? That was a lot of information for you guys. Hope you got a lot of value out of it though. If you did, please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. Hope you have an awesome day. Look forward to seeing you on the next video.